Let's take a look at some of the releases that have come through from Kenya, and of course starting with the results from that we've seen so far from Barclays. We saw some good results there, and the Kenyan Bankers Association has announced that the profitability in the banking sector jumped to 108 billion shillings on the back of high lending rates, raising concerns about the need to control the situation since lenders are making abnormal profits in an already weak economy, and that of course that number for 2012. So let's delve into this now with George Bodo, head of the financials desk at EcoBank. George, thank you for your time. So basically what they're saying is that lenders are making abnormal profits in a time when the economy is under strain in some areas, and of course still very tied to what takes place internationally. And of course there have been pockets of strength but pockets of weakness as well. But let's get back to the banks. I mean, are they making abnormal profits right now, do you think?
I don't think they're making abnormal profits because, one, if you look at it, a 20% year-on-year growth on bottom line, the industry's net bottom line, is not something to write home about. The thing is that, one, people need to understand that three main reasons are behind this. I mean, one is we are coming from a low base effect. If you look at, the numbers on a quarter-on-quarter basis, the only time that a bank's net bottom line increased on a quarter-on-quarter basis was in quarter two, when it was about 15%. Now, quarter three, PBT of the industry was down 3%. Quarter four, it was down 2%. So it just underpins the fact that we are coming from a low, it's a combination of low base effect. Mm-hmm. The second thing is the fact that if you look at the Kenyan banking sector, I mean, the asset quality has been impressive. We've not had banks setting aside huge amounts of cash to cover for certain toxic position. Mm-hmm. If I can take you out of Kenya, you look at the big names like UBS and Barclays reporting net losses for 2012. It's because they made significant provisions for certain aspects of the operations in 2012. We've not had that situation in Kenya. Banks have not had to provide for certain toxic position that chucks significant amount of cash from their P&L. So on that basis alone, I don't think that these things outperforming economy. And the third thing, obviously, that Kenyan banks are very good at sweating their assets. I mean, if you look at Barclays, for example, quarter-on-quarter EPS for quarter four was about 26% growth. And you look at the loan book growth was just only 5%, It just shows that banks in Kenya are very good at sweating their assets.
Yeah. Let's get back to the issue around bad debts, because what you're saying almost contradicts what the Kenya's Bankers Association is saying, because they point out the fact that volume of loans not being serviced has grown to 61.6 billion shillings. That's compared to 53 billion shillings in the previous year. So they're concerned about the fact that households are increasingly not repaying debts.
Well, there's that marginal rise on a year-on-year basis, but if you look at it, we are still below the red line. I mean, this country's overall asset quality is still below 5%, which is not a concern. If you look at this country 6 years ago, the asset quality was, gross non-performing loans to total loan book in the industry was about 20%. And we've had a lot of asset repairs going on in the industry. We've got names like National Bank of Kenya, Government of Kenya coming in and writing interest, coupon-free bonds to settle all those debts. We have KCB doing a lot of asset repairs. We've had other names doing a lot of, even Barclays itself. If you look at Barclays in 2009, gross non-performing loans non-performing loans to loan book was about 7%. We are now talking about below 4%. I mean, they've done a significant amount of, a lot of balance sheet repair has gone on in this country. So what I'm saying is that there will be that aspect of marginal year-on-year rise. Yeah. But it's still below the red line. We're still way below the red line. So that I'm saying that banks will continue to sit on significant cash. We are still going to see a lot of provision write-backs, a lot of recoveries going on, especially I think when you also look at the Barclays numbers today, there's a significant recovery on bad debts, especially in quarter four, that overall brought down brought down its overall overheads to below 50%. I mean,
yeah, so George, what you're saying, I mean, the quality of assets isn't an issue, but I mean, you're talking about the red line and interest rates and lending rates, the average rates that you're seeing from commercial banks are certainly above the red line that the authorities in Kenya are happy with. I mean, if you look at the central bank lending rate sitting at 9%, and that, of course, indicates how much further below average lending rates it is. I mean, can banks afford to reduce their lending rates right now?
There's room, absolutely. There's room for banks to reduce the lending rates, and in fact, as right now, average base lending rates are about 17-18%, way up from 25% last year, Q1 and Q2. So there's still more scope. Let me just give a bit of perspective here. We are looking at a 10% year-on-year growth in lending, private sector lending in Kenya as of 2012. The central bank had a target of 20% annualized target. So it's the growth in lending in the country did only half of central bank's target. What you're saying is that the central bank certainly has more room to bring down rates, and the banks consequently have more room to bring down rates. We are probably targeting 14% on average base lending rates in this market. I mean, it's not only a Kenyan phenomenon. I mean, if you look at all the key markets in this region, especially in the sub-Saharan region, private sector lending was below 10%. I mean, look at places like Nigeria was 8%, South Africa was 11%, Ghana was probably estimated 10%. So, I mean, it was still way below the target of the regulators on the desired growth target. So, I think if you look at Kenya in this region, talking about if you look at it outside Kenya, there's still more scope for central bankers to be dovish enough and ease lending conditions.